So now we come to the whole business now of, we have looked at Disney, we have looked at it as an organization that is moving, that is thriving. We now move to the whole business of definition of strategy. And as outlined in your text, a strategy then is a firm's theory about how to gain competitive advantage. What do we mean by competitive advantage? We are basically saying that, well, I need to do something that I'm doing better than the competition. So therefore, Disney has moved into films. Disney is saying, well, what sort of films do we need to do to capture a larger market share from Metro-Goldwyn-Mayer as a competitor, or any of the other major film producers? So that as a result of that, they moved into that area. So that what Eisner is saying, the new man on the block, and looking at where the organization is going, is that he is prepared to say that if you have a premium product, and what we mean by a premium product is one that basically you're saying that it is unique, people want it, it's the right price, it's the right quality, the standard is acceptable, and therefore they are prepared to pay for it. So once we have a premium product, we are going to ensure that we have a premium price. And as a result of a premium price, then the bottom line is that if we control our expenses, then the chances are that our profitability will go. And that is where Eisner is going, and that is his basic strategy. So if we look at it, then what we are saying is that we are looking at what do we want? We want more profits, we want more earnings per share, we want more revenue, and if increasing the price will cause that to happen and diversifying the organization, then that is really where we want to go. And that basically is good strategy. Now let's look at the strategic management process. The diagram shows that the strategic management process takes you from the mission to implementation. Now basically, in the strategic management process, you will have to look at what is my vision. My vision is to be the most profitable entertainment company in the world. But what's the mission? My mission is I have to coordinate my human resources, ensure that I have the right people in the right places. I have to look at my customers, what do they want, what price are they prepared to pay, how do I satisfy them. I have to look at my shareholders, my investors, to ensure that they're happy. I have to ensure that I'm a good corporate citizen in the sense of paying my taxes, etc., etc. So my strategic management process then is looking at crafting a vision, crafting a mission, and having done that now, we will now have to look at our SWOT, and the SWOT being the SWOT, our strengths or weaknesses, or the opportunities that are available there, and the threats. Our strengths and weaknesses are internal, and our opportunities and threats are looking externally as to what will impact on the organization. Having appropriately analyzed our strengths and our weaknesses, and having looked at the threats posed to the organization, having looked at the opportunities that are out there, we now we now look at what strategic choices we have. And so our strategic choice are, as Eisner has decided, do we go for a premium product? Do we go into diversification? Do we go into strategic alliances? Do we go into joint ventures, etc., etc.? Then now, that's a corporate strategy. Now we move from there to our business strategy, and Disney is in a lot of businesses, or many businesses. They are in entertainment studios, they are in the theme park, they are in shops selling memorabilia, etc., etc. So what businesses should we be in, and what should be the strategy for the business? Having now determined what corporate strategy, what business strategy, we now have to implement. And we have to implement in such a way that at the end of the day, the implementation is in line with the strategic direction in which we want to go. Having implemented our strategy, we do not just sit and look at it. We have to now determine that the strategy is working. And most of us are familiar with companies going on retreat. What do we mean by companies going on retreat? To most of us, or I wouldn't say most of us, probably to many of us, going on retreat means going to have some fun. But that is really not what a retreat is supposed to be. A retreat is supposed to be that I am looking at what strategies we have adopted. Are the strategies working? And if at the retreat they are not working, we have to analyze what we should do to change that. No, don't get me wrong. I'm not saying that retreats are all about business, because sometimes we need to take a little break from the hurly-burly, from the hustle, from the stresses, have some fun, have some good food, some music, get some Elephant Man and those guys to come and perform, and let our hairs down. But the bottom line really is that the retreat is supposed to be an analysis of where we are, and where we are now, is that where we want to go? And then now, if we are not going where we want to go, then the bottom line really is we now have to look back at our strategy. We may have to go back as far as whether the mission and the vision that we crafted was really the one that we should have been crafted, given the external and internal situation. So fine, our strategy in place, we have passed through the strategic management process. We are now going to have to look now as to whether that strategic management process gives us the level of returns that we want, and most importantly, the level of competitive advantage that is necessary. We now have to know, out of the strategic management process, we have to look at objectives. And we mentioned earlier that we were speaking to the fact of crafting our corporate and our business strategy. Now, that entails that having decided, as Disney did, that we want to get into movie studios, we now have to identify what is the objective of getting into that movie studio. Is it just to, as a complementary business, or is it that we want to have a higher level of profit? So our objective has to be, what is it that we want to achieve? Who should do what, how, and over what period of time? And so we have to ensure that our objectives are smart. They must be measurable, they must be attainable, they must be realistic, and must be time bound. So we have our objectives, we have our strategy, we are now moving on. But an important aspect of crafting the strategic management process, as was mentioned earlier, is looking at the internal and the external environmental analysis. What is the external environment analysis? In the external environment, we will have areas such as the political, the social, economic, the demographic, the technological, the political, etc. We have to look at what is politically impacting on us. So let's look at the Jamaican situation. In the Jamaican situation right now, we have the Jamaica Debt Exchange, which has impacted on the financial sector. What that has done is that it has pulled money out of the system, and as a result, there is less disposable income for most persons. Persons who are relying on their investments to give them a return of, say, 16% are now getting 7%. After the 7%, they end up with less than 4% return. Now, when they were getting 16%, they probably had extra money. And what was also interesting at that point in time is that the inflation was 12%. Inflation is now really about 12, but you're getting a return of 7. You, at the end of the day, your real return is 4 after tax. So you are now at the back. So if you are in the business of, say, Disney, and you are in Jamaica and you are in entertainment, it means that less people have disposable income. So that's as that economic decision is impacting on you. We have a high rate of unemployment, so therefore, again, the whole business of disposable income. We are familiar with the crime situation. So when you're looking at the external analysis, you have to now look at what is happening around you as an organization. When we look at the internal analysis now, we are looking at the strengths and weaknesses within the organization. So what we're asking ourselves is, what is the strength of our management? Do we have the skills, the competencies? Is there the level of leadership? How are we doing with marketing? Do we have the marketing skills? Do we have the research and technology that's available? Do we have the modern equipment, etc.? And therefore, that is part of that analysis. And when we look at the internal and the external, as previously mentioned, we can now move to our strategic choice. So we are still looking at the strategic management process, but we are now at the strategic choices that we get involved in. Now, what do I mean by the strategic choice? We have looked at the Jamaican situation. So I want to be in the business of selling flat screen television. Is the market available for flat screen television? In terms of my business strategy, am I going to get the most expensive television, or am I going to get the mid-level one or the low-level one, right? What is it that people can pay? So my corporate strategy, am I going to link up with Henry to determine that he is going to do the sales and I do the storage, which would now come to some form of a joint venture? That's my corporate strategy. Or is he going to am I going to do it alone? So that's part of my strategic choice. In my business level choice, am I going to be looking at, as I mentioned earlier, establishing my store in Ligani and have a high price, or establishing my store downtown at a lower price? Let's now look at strategy implementation. In strategy implementation, we are saying that we have agreed that the organization is going to be involved in diversification. So if we go back to Disney, we are saying that Eisner has made a decision that the organization is going to acquire more movie studios. It's going to get involved in probably transportation. It's going to probably be involved in acquiring an airline. So you'd be diversifying away from what we call your core business. That would mean that you'll have to have the necessary human resources in place. You have to have a structure that is going to be consistent with that level of diversification. You have to have the capital, you have to wherewithal, and most importantly, if you're going to be looking at acquiring businesses, you would have done the necessary checks and balances. You would have concluded, because most importantly, you have to let your shareholders know that the decisions are sound and they are going to get a return on their investments. So in looking at implementation, then we are going to be looking at, well, what is it that we have to do? Who is going to be doing it? What will be the cost implications? And in the long run, how will it benefit the organization? And how do we know that we are on the right track? So it's very important then that we have the necessary control mechanisms in place. Now, what do we mean by control mechanisms? We are saying that we have the necessary audit trails, we have the governance, the board is on top of things, management knows what it is supposed to do, and the ordinary employee has job descriptions and has the necessary objectives clearly identified.